Okay, today we have Brent Johnson, and I'm really excited to speak with him because, Brent, I've seen your stuff online and I've followed your theory, and I think I get it. But to hear it directly from you is just a treat for me, and I think you're going to help a lot of our audience just think about Canada, their own investments, their own future, maybe a little bit differently. So, just to begin, who the heck is Brent Johnson? Who are you? Let's just start with there, and then after that, I'm going to get you to go into some of your thoughts on the economy and currencies and the whole bit. So sure. Who is Brent Johnson?
Well, so long story short, I've got a wealth management firm. I've been in this business for a little over 25 years now. I started with a firm called Donaldson, Lufkin and Jenrette in New York City. And then I moved with them to San Francisco, where we were purchased by Credit Suisse. And so I was with Credit Suisse for almost 10 years. And then post global financial crisis, I decided that working for a big Wall Street firm was not the best way to serve my clients. And so left and joined a friend of mine who had his own independent wealth management firm, and then subsequently set up my own wealth management firm. And so I work with a little over a dozen families and individuals, kind of customizing wealth management plans for them. And we manage their personal wealth through a combination of separately managed accounts and then private funds. And so my job is to, manage other people's portfolios and try to anticipate where the world is headed and watch out for the rogue waves that come along every now and then and seem to wipe people out who aren't ready for it.
Yeah. Oh, cool. I didn't know that was your journey going out on your own like that. So you must feel pretty good. Like, I mean, you're in a nice spot working for yourself. I guess you have the stress of managing people's money. That's stressful, but you're working for yourself.
But you know what? It's, I suppose everybody's job is stressful in some ways. And so I'm not complaining because I feel like I'm the luckiest guy in the world. So,
yeah, cool. Good. Awesome. Okay. And so the first time I think I came across from you, I feel like you were speaking in Toronto. Maybe you weren't, but it was a YouTube video. You were on stage and you were talking about something called the Dollar Milkshake Theory. And I remember listening to it and I go, I think this guy's onto something. I think I understand what he's saying, but I remember having some questions. I don't know if I agreed with everything, but I didn't fully understand, where you were coming from. But since then, I think you just kind of like exploded, or in my mind, you did. Like everybody was talking about this theory. So for, Canadians who are trying to understand currencies, the dollar, and where to put their money, could you maybe just explain, is that a good place you think to start with your Dollar Milkshake Theory?
Yeah.
Okay.
So first, the whole Dollar Milkshake Theory came about as a result of me trying to figure out a simple way to explain to my clients what I thought was going to happen. So again, as background on what I actually do is I manage money for individuals. So I'm not managing money for big pension funds or large endowments. And the people on the other side of the table for me are not financial professionals. They're, super smart, entrepreneurial, high-level executives, but they're not necessarily steeped in monetary policy and financial lingo. And they could probably manage their money very well if they did it themselves, but they either don't have the time or
they're busy.
That they're busy, right? And so they've hired me to kind of take on this role for them. And so they kind of want to know what's going on, but they're not going to sit down and read a 10-page paper put out by the Federal Reserve, right? They're just not going to do that. So I've got to kind of figure out a way to explain all of these different things to them when I'm explaining to them how we're allocating their portfolio and where we think it's potentially going to go. And so the Dollar Milkshake Theory started off with how I thought markets would react to a global sovereign debt crisis. And the reason I expected a global sovereign debt crisis, which, by the way, has not happened yet. We've gotten close, but it hasn't happened. But how I thought markets would react in a global sovereign debt crisis. And it's really a framework. It's not a one-time event. It's more of a framework for understanding how markets interact and what would happen in this scenario. And so I started talking about it in 2018, but I really started talking about it more in 2019. And what I said was that I thought we were coming to an end of the low and negative rates area as far as fixed income and bond prices. And I thought that in the years ahead, interest rates would rise. And as a result, I said there would be a handful of things that I thought would manifest itself in the rest of the market. And I said I thought the US dollar would rise versus other currencies, not necessarily purchasing power, but it would rise versus other currencies. despite all of the rhetoric about the dollar getting inflated away and the de-dollarization of the world and the rise of the BRICS, and the U.S. was in this terrible financial position and there was no way they could possibly get out of it. And my point was that despite all of those problems, it's still going to rise versus other foreign currencies because all of the other countries have the exact same problems that the United States does, but they don't have all the advantages that the United States does. And so it's a relative game. And the point was that if you analyze the United States in isolation, which is what I feel like most analysts do, the only possible conclusion you can come to is that it's in a really bad situation. It's going to end in disaster. The problem with doing that type of analysis is that we don't just live in the United States. It's a global world. It's a global market. And to ignore everything that's going on elsewhere is to kind of miss the forest for the trees. And on a relative basis, despite all its problems, the U.S. still looks pretty good. And so I thought as the dollar got stronger, as interest rates went higher, it would pull capital into the United States. That would make the U.S. dollar stronger. But then kind of maybe unexpectedly by some, it would also see gold rise. It would also see U.S. equity prices rise. It would see bond prices fall. And it would see the U.S. outperform the rest of the world. And if I look back over the last 5 years, that's pretty much exactly what's happened. Interest rates have gone up, bond prices have fallen, the US dollar has risen versus foreign currencies, US equities went much, much higher, and gold went up a tremendous amount. And so while we haven't had the crisis that I thought would come, the overall market reaction to all those dynamics has played out. And so that has allowed us to kind of understand what's been going on in the markets despite all the craziness. It's allowed us to kind of sidestep some of the crazy drawdowns and volatility that's been, seen at times over the last 5 years. And it's really given us a roadmap of how to think about things going forward. Now, the other thing that I said at the very beginning was that I would try to walk it out in a linear fashion as a story so that everybody could kind of understand it. But I made it clear that there's no way I'm going to get this all right. I mean,
sure,
you'd have to be a complete narcissist, egomaniac to think you're going to get it all right. And I said I wasn't totally sure on the exact progression. I didn't know if it was this would happen and this would happen, or this would happen. It's just that I thought these factors would happen. And like I said, they have. And so it's been a great framework for us to use for the last 5 years. And I haven't seen anything else that explains what's happened better than this framework. It doesn't mean that nobody else has been right and there hasn't been solid contributions by anybody else, but I haven't seen anybody who's been able to, quote unquote, prove me wrong. And it's served us pretty well. And we don't think that this framework needs to be changed for the next, well, at this point, it doesn't need to be changed. We're always on the lookout for something that would change it, but so far it's helped us a lot, and we think it will continue to help us, as we move forward in time.
Okay.
Oh, but I should say the milkshake, the reason it's called a milkshake is because, over the last 20 to 25 years, whenever the world has gotten into a crisis, the monetary authorities, the central banks, the governments around the world have always responded by injecting new liquidity into the market, whether by bailouts or stimulus plans or fiscal spending or quantitative easing. They respond by injecting new liquidity into the system. And the milkshake theory is the idea that everybody creates the money or the capital all over the world, but then that gets sucked up into the United States because of the advantages that the United States has. And so the U.S. has the straw that drinks the rest of the world's milkshake. So that's kind of where it comes from.
So then, okay, there's so much you cover in that. So then if I was to kind of just summarize really briefly, the era of low interest rates is over. Higher interest rates, relatively higher interest rates, here to stay. Because of that and the advantages that the U.S. has, money flows into the U.S. dollar, money flows into the U.S. and places like Canada that don't, that don't have the privileges or don't have the reserve asset status that the U.S. dollar has, we are left to kind of suffer the consequences of debasement and some of the things that are going around the world in a more aggressive fashion than the US will. Is that fair to say?
That's right. And so this is kind of the point I've always made is that while, yes, the US dollar over time will lose purchasing power, as all fiat currency historically does, it will not lose purchasing power as quickly, in my opinion, as foreign currencies. So whether that's Australian dollars or Canadian dollars or British pounds or Turkish lira. So it's not a thesis that says the United States dollar is a great store of value. It's just saying it's much better than all of the other currencies, and that especially if you're not a U.S. citizen and you live abroad somewhere else and you're denominated in a currency other than the U.S. dollar, it would probably make sense to put your savings or some of your cash reserves in U.S. dollars, because it would appreciate against your local purchasing power and potentially against your local cost of living.
Hey everyone, before we get back to the podcast, I've got a quick plug for our weekly Tuesday email update. Every Tuesday, we send out a short and actionable email sharing 3 things the Rockstar team is focused on that week. We dive into the latest data, news, or a chart on the real estate market that's caught our attention, and we give our take on what it means for Canadians. We also share one of our most popular pieces of content, something that's really struck a chord with our community. Plus, we often offer free training classes, special events, live streams, and one-off classes for investors. It's a great way to stay on top of new strategies and learn from our experts without spending a dime. If you want all the insights, upcoming events, and some behind-the-scenes fun, sign up for our weekly Tuesday email update for free today. Sign up now at rockstarinnercircle.com/get started and never miss an update. That's rockstarinnercircle.com/get started to level up your investing.
And we've kind of seen that play out around the world. Even though the dollar has lost value versus things like stock prices and gold, in many other places around the world, who often do save their excess savings in U.S. dollar, it's actually kept up with the cost of living increases in those jurisdictions.
So maybe your theory is like, you know how you thought it would be a sovereign debt crisis? Maybe like we're in the sovereign debt crisis. It's just that like there's like a domino effect to it. Like it's a series of events and that we're in it. And maybe there is one big switch that gets triggered at some point. But to me, as a Canadian living here, I've never heard Canadians speak like this. Like, oh my gosh, we were thinking of going to the States on vacation, but have you seen the exchange rate lately? That's kind of, we have had that since I've been, I'm born here. We have had that over the years, but you hear it much more frequently now. And then if you go into a place like Costco, you'll see like a bowl of fruit salad can be like 25, 30, 35 bucks. Like I'm talking a bowl of just fruit salad. So I think, and I think most Canadians don't see what's going on. You don't know this about me. I have family from Croatia, and they lived through hyperinflation. The Yugoslavian dinar imploded on my family over there. So when I hear some of these things, I get like flashbacks to when I was younger and I would visit them over there. And they would always try to hold, in the 80s, they would try to hold German marks. As the dinar was losing value, it's like you held German marks. And I see the same thing in Canada where people are starting to say, I need a US dollar bank account. And I don't know if they're connecting all the dots, but when I hear this, I'm like, our currency is failing. You just don't see it yet. We might be in the early innings even for Canada, but it's failing. And I think your theory is that, sure, the US is losing purchasing power. So all the Americans who tell you, who are screaming US dollars losing purchasing power, your theory is more like, yes, it absolutely is. But we need these other currencies, or not need, maybe that's a bad word to say, but these other currencies around the world are going to lose their purchasing power much sooner. And then when they all lose their purchasing power, then maybe eventually the US dollar is finally going to lose its. That's exactly
right. So that's exactly right. I see it as a progression of dominoes, and it starts on the periphery and it comes into the core. I'm not saying that the core can't ultimately, have the situation of, let's just say collapse, for lack of a better word, right?
Sure.
I'm not saying that can't happen. Mm-hmm. I'm just saying that the collapse is not going to start in the core and emanate outwards. It'll start on the periphery and, be a progression of dominoes inward. And that's the other thing I should point out is I'm not saying that the U.S. doesn't have problems. I'm not being Pollyannish saying, don't worry about it.
Yeah, got it. Yeah,
not
yeah.
at all. And
You're just calling the sequence of events.
Yeah, and the very first time I ever spoke about this publicly, I think the very first sentence was that this is a story that ends very, very badly. Because the type of system that we have, it's a debt-based monetary system. The debts have to grow in order to stave off collapse. But eventually the debts will get so bad that there will be this massive deleveraging where the whole system will have to either be reset or will come down in some kind of a catastrophic disaster. I don't know if that's going to happen next week or 20 years from now. I just know that something can't go up forever, like the global debt is doing. And I think when that happens, again, it'll start on the periphery and it will kind of come into the core. And in many ways, my thesis and my pounding of the table on it is to counter the endless stories and narratives about the U.S. dollar going to collapse and hyperinflation.
Yeah, it is fun. It is fun to talk about that, though. But I get it. I get what you're talking.
It is. It absolutely is. But
fun in the most horrific way. I should be clear.
Sure.
Like fun in a very horrific way. Yeah,
it is. But I think it leads itself to a misunderstanding of how the system actually works. And my fear is that when people hear that, then they run out and they put all of their money into Bitcoin or all of their money into gold or all of their money into some other asset that they think will hold purchasing power over the long term. And perhaps it will. I'm not saying it won't. But, some of those assets are also very volatile, right? And just because something is inevitable doesn't mean it's imminent. And, I'm somebody who still does believe in diversification. I don't think you should put all your eggs in one basket. And so, in many ways, I've just tried to kind of educate people on how the system works and why it works that way in order to kind of understand what is most likely to happen, in the years ahead.
Okay, so then I'm interested in your view on Canada because I want to get your view on like where Americans should invest and where you're advising some clients. But now if you from the outside look at Canada, and we have been helping people buy rental properties because that's been one way, relatively speaking, maybe not against the US dollar, to protect your purchasing power. When 2008, 2009, when we started this business, you could buy a nice single family home on the outskirts of Toronto. So maybe 45 minutes to an hour outside of downtown Toronto for about 200, 225,000. Those same properties are now 650 to $1 million.
Yeah.
So like it has been, it's been a quote unquote relative good story within Canada. But you, from your vantage point now looking in, and be honest, talk to me, say what you want about real estate, say what you want about Canada. What would you advise some clients who are in Canada earning an income in Canada and maybe have jurisdictional risk because their net worth is in Canada? What would you say?
Well, so first thing I'd say is I think land, property, real estate, however you want to define that space, is an extremely important part of an overall portfolio. And especially, if the currency in which you are denominated in is likely to lose purchasing power. So from that perspective, I absolutely like the sector. Having said that, I would be very careful about allocating a huge percent of your portfolio to that sector by using leverage to get it. So what I mean by that is, I think if we go into some kind of a crisis, either a crisis due to fiat currency losing purchasing power, so a highly inflationary environment, or even some kind of a deflationary event, I think over the long term, real estate is a great way to store your wealth relative to other choices. But it doesn't mean that there can't be a drawdown in the short term. And that's why I say be careful buying it with leverage. And I think that Canadian real estate is particularly,
say it.
I don't want to say dangerous.
Say it.
Dangerous isn't the right necessarily word, because again, if you have the timeline to hold on, it's not.
Yeah, if you have the ability.
dangerous.
Yeah.
But if you've bought it with a bunch of leverage and you can't withstand a 3 or 4 or 5 year drawdown while prices reset, then you could get into trouble. And the reason I think that Canada is particularly exposed to that is the incredible performance it has had over the last 20 years. You know, when the United States,
we're good at printing money and dropping interest rates. We're experts.
Right.
We're experts up here.
Right. And if you, I don't have the numbers right at my fingertips. I have them kind of in a presentation I did a couple of years ago. But if you look at the numbers of the Canadian real estate market and you compare them to the United States in 2008, they make the United States bubble look like nothing. I mean, they're orders of magnitude more dramatic than those numbers were. And the reason I think that's potentially a problem is because I think a big part of that is tied to the rise of China and the incredible amount of wealth that has been created in China and then left China and invested overseas in places like Australia, United States, and Canada. And I think what's going on in the world now between the United States and kind of everybody, but specifically China, is that the world is kind of bifurcating. It's no longer globalizing. We're moving towards two systems rather than one system. And I think as part of that, we're obviously going to have tariffs. I think we're probably going to have capital controls. We're probably going to have forced repatriation of capital from overseas investments back home to domestic. And I think if Chinese citizens become sellers rather than buyers, the other thing I'd say, prices can come. You don't have to have sellers for prices to come down. You just have to have an absence of buyers. But then, if the Chinese then actually became sellers, that could have very serious effect on Canadian asset prices, I think.
I think that's really interesting what you're saying. Sorry, is there more?
No.
Go ahead. Okay, so that's really.
So the point is if you bought $1 million apartment complex with 10% down and 90% leverage.
Sorry, that would be a condo, not an apartment complex. That would be one condo in Toronto. But go on. Yes, I get your point.
The point is that perhaps in some kind of a drawdown, that condo goes to $600,000, right? And now you've got a $900,000 loan with a property that's worth $900,000. Now, if you have the staying power for the next 10, 20, 30 years, whatever it is, maybe that's not a problem. And against your home currency, maybe that's a good place to store your wealth. But it doesn't mean you can't get knocked out from a leverage perspective in the short term. Does that make sense?
Yeah, absolutely. Okay. And you hit on something a while ago. We just looked at something really basic, like foreign investment coming in from China. We just looked at the global GDP. What was the size of Canadian GDP? How much foreign reserves was China selling over the last few years? Of their drawdown in U.S. Treasuries, let's assume some of that escaped the country. What percentage would come to Canada? And Canada is such a small economy that if just the percentage that came into Canada was equal to our percentage of global GDP, it would affect our real estate market in an absolutely massive way, which is what happened. It doesn't take much. Right. We're a big land population, but a small economy relative to the U.S. So that definitely happened. My question to you would be, Canada has 5 big banks, and real estate and construction in this country is our industry. Do the big banks I guess this is where my mind always goes. I'm like, okay, yeah, I see what Brent's saying. I kind of agree. That's an absolute risk. But
I think, I think the Canadian banks are in a lot of trouble.
Okay.
I think that's probably.
I do too. I think that too. And no one believes me because we're so trained here to think our banks are the best banks in the world. And they're immune. And the great financial crisis, they survived it all, no problem.
Well, so here's where my thesis comes in, is that, of course, the Canadian governments, the Canadian monetary authorities are not going to let the banks fail, or at least they're going to try not to let them. If the banks go into some kind of a funding crisis, the Bank of Canada will provide them some kind of a bailout. And that will probably be done in the form of, quote unquote, printing more Canadian dollars, which then could precipitate the decline of purchasing power of the Canadian dollar. And so so maybe
so then you would want the real estate then, no, if you could hold it.
Well, this is my point. And so they will try to save the real estate market at the expense of the Canadian dollar. Mm-hmm. But that doesn't mean that the Canadian dollar won't fall versus the US dollar and US asset prices. So maybe your Canadian denominated debt is not a bad deal because they will save the quote unquote assets by printing more Canadian dollar, that doesn't mean that those assets couldn't fall dramatically versus the US dollar.
Agreed. Okay. Yes. Because that's how I see it too. I'm like, they would save the Canadian banks, which ultimately then in Canadian dollars, your real estate, as long as you could survive the bumpiness of that, whatever that period is, likely in purchasing power within the country you'd be better off holding the real estate as long as you could survive it. However, relative to the US, you might be losing faster. So then in that way, so then I guess then for Canadians that are looking to the U.S. and U.S. equities or U.S. real estate, like or gold, like what would you say to a Canadian here if you had some friends up here and you were kind of advising them just in general? I'm trying to paint
I would advise them to hold U.S. assets to the extent that you're able to do that.
So equities,
or even just U.S. dollar cash, or T-bills. So let me give you an example. Now, I'm going to use Australia as an example, but I think by the way, before I forget, about 10 months ago, we wrote a report on this exact topic. So if you remind
got it.
I'm happy to email it to you.
Oh yeah, please. Thank you.
And it's about the interconnectedness of the global real estate market. And in doing that, we realized how similar Canada is to Australia from an economic perspective, both their exposures to the United States and their exposures to China. And they both have huge real estate. I would call them bubbles, but let's just call them markets to be polite.
Sure.
But the point, I met a guy from Australia who worked in the property sector, and he tends to agree with everything that I'm saying and that you're saying. And what he does with his excess money, with his excess savings, I mean, he has some stocks and he has some gold, but with his excess cash, he holds it in US dollars and buys US T-bills. And the reason, and he said it's been great because because I get 4% for holding a T-bill, which is the closest thing to cash. And as the Australian currency has lost value versus the US dollar, I've gotten, 4% on that depreciation. So basically I'm getting paid 8% in local currency terms to hold cash. And so I think that's what I would say to somebody in Canada. If you think about it like that, the rates in the US are higher than they are in Canada. I would argue that T-bills are safer than Canadian bonds, especially when you consider that Canada will most likely have to bail out its banking system if this problem in the real estate market develops. And so, I certainly wouldn't keep all of my, and I'm not saying, listen, I'm not saying you need to sell everything you own and put it all in the United States.
Sure, because that's what some people are going to hear. But that's fine. We get it. You are being clear. You are being clear.
Yeah. But I would certainly not have all of my money wrapped up in Canada, in Canadian dollars, Canadian banks, and Canadian real estate.
Mm-hmm. Wild. Okay. So then where do you see this now headed in the U.S.? Let's just flip now to a U.S. focus. What do you think the next steps are by the way, I just need to tell you, you probably know, but Canada, we just got a new government in here. We didn't release a budget. We did not release a budget. Do you know this? We're due for a budget, and the current government came in and just said, you know what, that whole idea of a budget, what's the details? What are we going to do? So they're not releasing a budget. So we won't have a budget. So it's been a year since we had one. So it'll be next year. So we'll go through 2 years with no budget. I have no words, but I guess that goes to your whole dollar milkshake theory, actually, where all these other countries are doing.
One thing I would say is that I think the world, and I mentioned this earlier, I think the world is moving towards two quote unquote parallel systems as opposed
to sorry, I was going to ask. Yes. Yeah.
And even though I know there's been a lot of short-term rhetoric about, the United States and Canada no longer being allies and I ultimately believe, and I think a lot of that, I even sent this out in a tweet. I said, the way Carney's talking, this was like a month ago, I said, the way Carney's talking now will be dramatically different after he gets elected. Mm-hmm. So he's talking tough about hating Trump and not doing business with the United States. He even said something like the long relationship between the United States and Canada.
It's over.
And listen, I think once cooler heads prevail, which I think they will, and they already are now that he's gotten elected.
I think they are. Yeah, exactly.
I think the United States and Canada will be back to their strong relationship. Now, is that a guarantee? No, I'm not guaranteeing that, but I think that's most likely to happen. And so I think, I kind of feel like the United States and Canada and Mexico, really kind of North America, and even you could even throw South America and Central America into this, is I think what Trump's plan is he wants to make, the Western Hemisphere the dominant region for the entire world. And maybe it will be done a little differently, and maybe the language will be a little bit more crude and rough, and maybe we're still ruffle some feathers about Canada being the 51st state every now and then. But ultimately, I think the economies will become more integrated rather than less integrated.
Yeah, agreed. Maybe just some further economic integration. Because when I look at it as a Canadian up here, I'm like, sure, if I was the US, we have all this fresh water, we have all this lumber, we have all these minerals, we have all this energy. Like, if the world is going to go away from a global economy to more two systems, as you're describing, you would need all these natural resources, especially economy the size of the US. So it just kind of seems like a natural fit.
I mean, if you were playing a board game, and it was a risk, right? Yeah. And you're looking at the global map, the first choice of where to buy, you would take the United States, Mexico, and Canada every time. And it's not even close. Just from a geographic
that's a good way to think of it. Yeah, exactly.
From access to oceans perspective, from a natural resource perspective, from an inland river system perspective, from a population perspective, it's just, we are fortunate that we have the greatest geography in the world. We just do. And perhaps it's not fair. Maybe we won the geographic lottery, but that's the way it is. And I think, the idea that Canada, the United States, and Mexico, if they worked together, again, which ultimately I think they will, I can't see any place in the world out competing them.
Yeah. It would be powerful. Yep. Okay. So then the way you look at the world right now, do you just see this then as the US is kind of, what's the next step? Is it just a continued evolution until, I'm just trying to think of, like, when I saw currency fail again with my family, it was failing in the 80s. People were trying to get German marks, getting out of dinars. The government really didn't like that. It was a communist country, so capital controls were in place. The whole bit, it was definitely black market stuff where people were trying to get the German marks. And then eventually war breaks out in the early 90s, currency hyperinflates, it's gone, it's over. And I guess if you had to guess where we are in the US, I guess it's just years of continued currency debasement. Like, is that what you're kind of?
I mean, part of the reason I think the US dollar will rise is because fiat currencies are a relative game. And again, when I say dollar rise, it's versus all the other currencies. So I think what you just described happening in Croatia is going to happen in other places all over the world. And as those currencies fall, then the U.S. dollar will rise.
And in that process, is the U.S., how much purchasing power is the U.S. dollar losing during that period? Yeah, because I know it's rising relative. I'm just trying to.
It's a good question. And I don't know. I think there will be periods where it will lose purchasing power, and there will be periods where it will gain purchasing power. Okay. Right. So I don't have a really good answer for that. But again, if you're in Croatia and you're going through hyperinflation, you're going to want to own dollars, right?
Yeah.
And that's why, all over the world, especially in emerging markets and non-developed markets, businesses, individuals, institutions, they save in US dollar.
Yeah. What you're saying is accurate, because in Croatia, people went to Swiss francs. That's what happened. It was like, I don't trust the local currency. If we're doing any deals, denominate in Swiss francs, which was horrible because people in the country earned the local currency, but any debt that you had was denominated in Swiss francs. So it was a horrible period.
Right. And I should say, we haven't really talked about this, but part of the reason that the United States is able to, quote unquote, get away with these, crazy fiscal policies and the printing of money and the bailouts, and the dollar hasn't lost significant value versus its fiat peers, is largely due to the demand for the dollar outside the United States. In other words, the reason
makes sense.
Was it the Croatian dinar? Is that what it was called?
Yeah, it was like the Yugoslavian dinar. Yes.
Okay, so the reason it went into hyperinflation was not just because nobody internally wanted to use it anymore. It's because there's no demand for it externally. So all of that money just stays in that country. But there's no demand in the United States for Yugoslavian dinar, right?
Sure.
There's no demand in Chile for Turkish lira. There's no demand for South African rand in Canada, or maybe a tiny bit, right? But there is incredible demand for US dollars all over the world outside the United States. And so that allows the United States to, quote unquote, print enormous amounts of money. And it doesn't necessarily debase the currency as quickly as it would somewhere else because it gets absorbed by all this demand outside the United States. And the reason there's so much demand for the dollar outside the United States is there's this whole system called the euro dollar market. So the world, if you take the US out of the picture and you look at all the commerce that goes on between all the other countries, it is primarily done in US dollars. So that's the euro dollar market. And it's a debt-based system, and there's just as much US dollar debt outside the United States that the rest of the world owes to each other, not to the United States, in US dollars, as there is US dollars in the United States. And so the demand for dollars to service that debt and pay off that dollar debt outside the United States creates incredible, ongoing, systemic, and relentless demand for US dollars. And
yeah,
so
we have two companies in. Sorry, go ahead.
No, but the point is until all of that dollar debt is paid off, there is demand for dollars. Even though you might think it's ridiculous, even though you don't think it should be that way, that's the way it is.
Yeah, I guess we're going to a place where, like my example, where people were holding German marks, even though they were using dinars in the local currency. Canada's already to the spot. I can see it now where we're using Canadian dollars, but more and more of us are like, do you have a US dollar bank account? That wasn't a thing. We're here now in Canada. That's like a conversation. You guys aren't at the point yet, but I can see it coming in the US next, where it's like, yeah, US dollar still alive. It's working. But do you have, how much gold do you have? Do you have some Bitcoin? What's your US equity exposure? Are they paying dividends to a rate that makes you happy? Whatever it is, you have this other savings thing that you're now thinking about, whereas Americans have never thought that way before, in my opinion. It was just like, have American dollars. And you guys aren't there yet, I don't think. We're entering that phase. And to me, that's new for a G7 country like Canada. That's new for us, where people are like, yeah, I want some US dollar exposure. The more everyday Canadian is now starting to talk that way. So like you can see the evolution of your theory, and we're now at your borders, Brent. That's what I'm trying to say. We're at at your border. Okay, I wanted, just before we wrap, I wanted to sneak in this question. Interest rates. So is you're thinking that interest rates are just now relatively higher to what they were for the 2010s, and even if and part of the reason they could stay higher, because in my mind, like GDP has to grow, you can't have interest rates too high, GDP growing less than the rates with debt to GDP this big. But I guess in your thinking, maybe if inflation is like higher than it has been, rates can stay higher, because if, let's say inflation, I'm just going to pick a wild number, 7%, and rates are 5%. Well, then real rates are low. Like, is that your thinking, that we can have rates higher just because inflation is going to be higher? Yeah,
I think in general, interest rates will stay structurally higher than they were for the last, let's call it 10 or 15 years. I think the caveat to that is if they come down in a significant way, I think it's because they're crashing lower due to some kind of global deflationary event where everybody's just rushing to the safety, quote unquote, safety of bonds. Now, to be clear, I'm not a bond bull, and I'm not saying bonds are safe.
Sure.
But if the world perceives them to be safe, I could see people leaving risk assets, going into government debt, and having a very quick fall down in rates. That's not my base case. That's not my expectation, but I can understand. If somebody has that argument, I can understand that argument.
Yeah, to me, it feels like the market's starting to think they'd rather be in what was once called risk assets, and like, no, like we see what's happening. Let's go into something like equities or some good dividend.
Well, so what you just touched on, and let me say this really quickly before I forget. That's part of the reason in the milkshake thesis, I thought that U.S. equities would go higher, because they would sort of, in a weird kind of way, be for treasuries. If money now, because if we're in a sovereign debt crisis, which means interest rates are going higher, bond prices are going lower, and investors are selling sovereign bonds, that money has to go somewhere.
Yeah.
And so I think some of that money will show up in U.S. equities. And I think that's largely why, equities have done so well over the last couple of years.
Okay. And then so for someone in the U.S., is that one? I know everyone's different on their investments, so I know this is a difficult question to ask you, but is that just generally what you would suggest people in the U.S. be exposed to now? U.S. equities, it sounds like a little bit of some percentage of gold, that kind of mix?
Yeah, exactly. And it gets really tough because while we definitely have exposure to equities and I expect them to go higher in the years ahead, it is going to be crazy volatile along the way. And so we're constantly, applying hedges to our exposure in the event we get one of these terrifying drawdowns like we just had. And so, and this is what the whole framework that I've talked about has helped us with. It's helped us remain in equities, enjoy the upside of equities, but also have hedges in place so when these terrifying drawdowns come along, we don't get wiped out. And we understand why they're happening. And so,
so you have the big picture that allows you to kind of survive that drawdown and stay for the long term. It's good. Yeah. So Brent, I just want to honor your time here. And by the way, I'm going to come and visit you one day and we're going to talk about Bitcoin a little more because I didn't get to talk. And I'm sure you would love that conversation. I'm sure you would just love talking. Okay. So for anyone looking to find you or, that wants to know more about investing with you, where's the best places to check you out?
So there's a couple different places. So if you want to contact me, if you just go to santiagocapital.com, that's our homepage, and it's got my contact information on it. If you like kind of the stuff that we've talked about today and you want to find out more of my thoughts on that, we have a Substack. It's santiagocapital.substack.com. There's both a regular version and a premium version. So we do a lot of writing talking about these types of topics. And then I'm pretty active on Twitter. You can find me there. Santiago AU Fund is the name of the handle, or you can just look up Santiago Capital. And then finally, we do a weekly show on YouTube. It's called Milkshakes, Markets, and Madness. And we just kind of talk about topical things or things that I think are kind of interesting and related to what's going on in the world. So several different ways to interact with us if it's something you're interested in doing.
Okay, and I'm going to link to all of those on the show notes here. So if anyone's listening in the car or whatever, you'll be able to find all of those. And then Brent, that report about Canadian real estate tied to Australian, is that something we can share publicly or is that just for clients?
Sure.
Or
Yeah. If I'll send it to you afterwards, and if you want to share with your audience.
If that's okay? Yeah. Okay. Because I think some people would love that. Okay. So if you're listening to this, we'll somehow share that. Check the show notes for details or something. We'll make sure that's available. And then the thing I want to say is you're a great follow on Twitter because you spark some debates with people. You'll get in there and ruffle feathers a little bit. And I think it's in a good way. You're just having fun and you're getting people to think and it's good.
Yeah, it's funny. I always say I take my job really seriously, but I don't take myself very seriously.
No, it works. It works.
I love getting in. I grew up playing basketball and I was an athlete all through college. And, during the games, we would always be talking to the other players, and there was always some quote unquote trash talk going on. And it was just, to me, it's just part of the game. It's nothing personal. So anyway.
No, it's great. It's great. Brent, thank you. You didn't know us, so really appreciate you taking kind of this risk of coming and chatting with us. I think our audience is just going to love that conversation. So really appreciate this. Thank you very much, Brent.
Thanks for having me.